Hi, welcome to this channel, Forex with Otabo. And in today's discussion, would be continuing in the definition of some basic terminologies in the Forex market, and we'll be starting with the bid and the ask price. The bid and the ask price, what this term signify in the Forex market. Let me remove my face so I don't obstruct the screen. So, quickly, in the first market, the bid price at this stage, for you to have gotten to this stage of my series of videos, I believe you've downloaded the MetaTrader 4, which is the money making app on your phone or on your computer. I believe you would have done that. So we'll be very practical right now at this phase. Very practical. Now, all of this won't just be sounding as theories. On this bid and ask price I'm talking about, I'm going to show you on your MetaTrader 4 what they are and how to properly interpret them when trading. So, simply put, the bid price is actually the price in which your broker gives you to sell a particular instrument. Remember, instrument could be commodities, could be currency pairs that are exchanging in the forex market, could be stock and what have you. So basically, the bid price is the price in which your broker gives you the opportunity to sell an instrument, as is the bid price. So let's go on with the bid price before we go on to the ask price. I'm going to show you an image in your MetaTrader 4. I'm going to show you an image what it looks like on your phone, so you see the bid price. Very practical. Okay, let's go. So on your quote, you see figures like this on your quote in right in front of the various currency and other commodities that you have on your quote. Remember, the quote is about the first icon below your MetaTrader 4 when you open it up. So basically, the first figures attached to every of these pairs is the bid price. So this is it. So at the moment I took this screenshot, if you want to buy, or if you want to sell, rather, remember bid is for sell. If you want to sell the Australian dollar against the US dollar, this is the price in which you could sell it at. This is the price. If you want to sell GBP USD, this is the price. This is the bid price. This is it on your quote. Now, if you go on to look at your chart, let me show you what the bid price looks like on your chart. On your chart, now this is Great Britain pounds against US dollar. Now on the chart, you can see this level. This level. This is what. This is the bid price. This is it. So this is the point. If you check your MetaTrader 4 on your phone right now, you're going to see it. You're going to see that it matches it. So this point is the bid price. It's always there. It's not hidden. So that means if I wanted to sell Great Britain pounds against the US dollar, as at the moment I took this screenshot, I will be selling at, so this will become my entry price. This is the point where I enter the market for a sell for the Great Britain pounds against the US dollar, 1.25055. And let's go to the quotes. Let's see if it matches it. Let's go back to the quotes. Great Britain pounds against the US dollar. I can see exactly 1.25055. So that is it. It's that simple. So the bid price is the price in which your broker gives you to sell a particular commodity. If you even if you once you want to execute a transaction, once you click on trade, it show you it's not hidden. Once you click on trade, you see it there. You see it. In my next slide, I'll show it to you. You see it clearly written, the bid price. You can see it here on the quotes, on the charts. You can see it on your quotes. Even when you click a trade, you're going to see it there, to be there. So that is bid price. As I believe we all understand the bid price. If you don't, please ask question. Try to be very, very practical as possible. Show the images, check your MT4, you're going to see it there. Now, just like bid price, ask price is the price in which your broker gives you an instrument to buy. So bid is to sell as ask is to buy. That is it. Bid is to sell as ask is to price. The same example we went through, the same thing, but now this is for a buy. Now you want to buy Great Britain pounds against the US dollar. At this moment, this is the price in which you can buy Great Britain pounds. The red line, 1.2508. So this is the ask price. This is the ask price on your phone. This is the ask price. You can see it. Now, once you go to your quotes, you can as well see it as the second. These are the ask price for all these currencies I have on my quote. So Great Britain pounds was 1.25082. So if you go back to your chart, you're going to see exactly. So that is it. That's basically the ask and the bid price. Now, how about on your computer? You can see it on your market watch. You can see it on your market watch. If you are trading with your computer, you can see it here. This is it, the bid price and the ask price. It's always there. It's not hidden. If you want to place a trade, as I told you, they will bring it out. They'll show it to you. You can see the euro against the US dollar. This is it on my market watch. How do you get to market watch? You can press Control M. I believe, well, if you follow the other setup in my previous video, you would have seen how to see your market watch. So you can see the bid price and the ask price. And remember, the same thing on the phone. It's also here. The bid price is the one below, while the ask price is the one above. That is it. That's simple. If you want to enter a new transaction, you want to buy or sell, click on new order. But market today is Sunday, market is closed, but it's still there. You can see it. This is it. So this is the bid price, this is the ask price. And they zoomed in on the chart to show you here. Very, very visible, very clear to show you here. The bid price, the ask price. You can see it. That is it. It's that simple. So okay, so I believe we can go on to the next basic terminology. So if you have any question, comment on the session appropriate, so I would answer your questions. So for now, we're done with the bid and the ask price. So on to the next basic term. Okay, talked about this already. This was is an image of what I just showed to you. The bid and the ask price. This is for Euro USD. So what is spread? What is spread? So basically, spread is this is how brokers this is where they earn their fee from you when you trade. It's very simple. The spread basically is the difference between the bid and the ask price. That is spread. That is spread. The difference between the bid and the ask price. Let me go to my MT4 and show you. Remember when we looked at this? So this tiny difference between these two, between the two lines, the bid and the ask price, the bid and the ask price, you can see it here. You can see it here, the bid and the ask price. So this difference, let me go to new order so we can zoom in on that. This is simply what you have here. So the difference between the bid and the ask price, this space now, it is called spread. Now this is basically how your broker gets their fee. So this is just spread. And I always advise people to deal with currencies or commodities that have a lower spread. So that way you get into profit easily. If you have a spread that is, you can see this is narrow relatively. If you have a spread that is very, very wide, very big, it will be difficult for you to get into profit. And you have a spread like this and you're selling, immediately you hit the sell. Remember, it is the bid price, the one below. So once you hit a sell, you expect the price to continue to go down. So that's it. So now immediately it starts going down. You don't get into profit until the one up crosses the price where you enter into. So if it is narrow, it easily gets into profit. But if it is wide, it is difficult. It takes a lot of time for it to get into profit. So always trade a pair or a commodity that has a very low spread. Now, spread differs with different brokers. It's not fixed. There are different brokers offer their different spread. So study your broker, study the spread. Always trade a pair that has a smaller a smaller spread. So that will be it for this. And let's go on with our series of discussion. We're done with spread. Oh no, okay, we're done with spread. So we're almost getting to the fun parts. We're almost getting to the advanced phase of this series of discussion. So basically, right now, I want to talk about the entry price. What is the entry price? Very simple. This is the price in which a trader either buys or sell a currency pair. Remember, I told you when I was explaining the bid and the ask price. Now, once the place is sell, the place is sell at that bid price. So that bid price becomes your entry price, or you place a buy at the ask price. That's price, that level now becomes your entry price. That was the point in which you entered the market. That is your entry price, or EP, entry price. Simple. Questions asked in the comment section. So we'll go on to take profits. The next basic term we'll be defining right now. What is take profits? Take profits is let me try and explain it. You can also read the slide. Basically, this is a point. This is the level in which you set your trade. You set it yourself. You set it. So at this point, what you're telling the market is simple. You can set it and you go to sleep. What it means is, at this point, when the price gets to this point, please take my profit and take me out of the market. Very simple. Very simple. It's not a robot. You set it yourself. And immediately price gets to that level, it takes you out in profits. So it is called take profit. Okay, let's read what we have here. This is an order which is used by a trader to automatically close their position once a certain profit has been made. Once it gets to that level, it takes you out. Even though price continues to go up, you're buying, once price continues to go up, it doesn't concern you. It doesn't concern your order. Your order has been closed. You have collected your profits. So that way you're good to go. It guarantees you profits. So you might be sleeping and then it goes on. Even as soon as it gets to that level, it takes you out of the market. It keeps your profits in your wallet. So that is take profits. Very safe to use. So you don't wake up and you see probably price was going up and then it hits the level in which you're expected to hit, and then now it starts going down again. But if you had set a take profit, by the time it got to that level, it takes you out. You've made profit. Now if it starts coming down, it doesn't concern you. You're safe. You're out of the deal. So the same thing buying, the same thing selling. So when you're selling, remember, price is going down. It is a bearish market when it is going down. When price is selling, you enter at this point. This is your entry point. Price is here right now. You enter at this point, and then price continues to go down. Now you set a take profit below. So once price gets to that point, the market takes you out of the market. So that point it takes you out is this take profit. The same thing for a buy or a sell. You set it. You're buying. Buying means the market is going up. So you set a take profit above. Selling means the market is going down. So you set a take profit below. So once price gets to that level, once it gets to that level, it takes you out of the market and keeps your profits. It keeps your profits in your wallet. That is take profits. Very, 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 very easy to use. Safe to use. So instead of you closing your trade manually, you can use a take profit. So you can be busy in the office, you're doing something else. When price gets to that level, it takes you out. So you don't have to you're always on your phone looking at it. Or where has it gotten to? Easy to use. So that is take profit. Now the same way we have take profit to help you take out your order once you've reached a reasonable level of profit. We also have a stop loss. We also have a stop loss, just like the way we have take profit. What does this mean? You're in a trade and it goes south. It doesn't go how you want it to go. Now, instead of losing your whole capital, it stops that from happening. That's why it's stop loss. It stops you from losing too much. It's an order, just like take profit. You place the order. Now, when price gets to a particular level, it takes you out. So, for example, you have $100 in your account, and then now you you're buying, you place a buy on a entry price, hit the buy, you're buying. Of course, you're buying, you expect price to go up. But unfortunately, your village people say no, today you're not going to make money, you're going to make loss. And then the price starts coming down. Instead of it to wipe out your whole 100 US dollar, what happens? If you had set a stop loss here, you set a stop loss and you go to sleep. Now, when you wake up, and it's going down, you see it has hit your stop loss. So that it takes you out of the market. Instead of losing your whole $100, you probably might have lost $5, $10, $15. It depends on the level at which you set it. It depends on the level at which you set it. So it is very safe. This is part of risk management. Now, subsequently, you're probably going to start trading. Always use a stop loss. Some people don't use a stop loss because they believe price will go down and then come back up. But it is very safe. It is very, very advisable to always use a stop loss because most times it just keeps going down, and then your money goes. Your village people will laugh at you. So always use a stop loss. It is very safe to use. Prevents once it happens that way, fine. You have hit your stop loss. You look for another opportunity to trade. So it's that simple to use. So I'm going to give. I believe we all understood that. So the example of the sell, the example of the buy, you're buying, you expect price to go up. Now you entered at this level. It's the level at which you entered. Now you place a stop because price is going up. So your take profit will be up, right? But if it is going south, if it's going the other way, it's going to take you out. It's going, you're in negative, you are losing. So you set your take profit below when you are buying. So when price starts coming down, it takes you out in minimal loss. It saves your money, it saves your capital, it saves your hard-earned money. So the same way we have that example for the buy, the same thing we have for the sell. Now you're selling, remember, bearish selling. You're selling, you're expecting the price to go down, So now, but unfortunately, village people come again and say, no, dude, you're not making money. Price starts to go up. You're selling, price is supposed to be going down, but now price is going up. Egungun is going up. And it's going to hit what? It's going to hit your express. What is the express? Express is your stop loss. He said, no, once it gets here, taking me out of the market and save me from losing all my money. So that is it. You're selling, you put your stop loss above your entry price. You put it above your entry price. So when it starts coming up, instead of going down, it takes you out and saves your money. So that is the concept of the stop loss. So I'm going to show us very practical. I'm going to show us the way the stop loss on your charts. Today is not a market day, so we can't do a live trading. I'm going to show you this. This was one of my transactions during the week. So this was, I think it was sometime last week or thereabouts. So this is a clear example. I bought euro against the Great Britain pounds at this point. You can see the point. You can see this line. You can see the line. Buy. I bought. My lot size was 0.01. So I bought the euro against the Great Britain pounds. I put my money that the euro is going to do better than the Great Britain pounds. So what do I expect? I expect this currency to go up. But at this moment I bought, this is where it was. 0.87746. So that became my entry price. So now what do I do so that I can sleep? And whenever I set and forget, so either it hits my stop loss or it hits my take profit. So what do I do? Since I'm buying, I come above. Remember, these are always the various price levels. I come above and set my take profit. I set my take profit above. This is it. This is TP. I set my take profit here. And then I come down in case the trade decides to go south. I come down and set my stop loss at this point. Set my stop loss at this point. So pretty easy. So that is basically the concept of, in short, in this diagram just simplifies entry point, entry price, take profit, TP, and a stop loss. That is it. How do you use it on your phone, on your device? Unfortunately, as I said, this is not a market day, so the market is not open today, so we can't do a live trading up, unfortunately. But I'll try and explain to you as much as I can. So once you have to place the trade first, then you go and modify it on your phone. When you buy or you sell, mainly you either buy or sell, the trade goes straight on to it goes on to the place where you have your running trade. What do? You hold on to it, you hold on to that pair, and you see it will bring some options: close trade, modify chart, modified trade, and the rest. So you click on modified trade. Once you click on modified trade, you see two columns, a red and a blue. Now the red is where you impute your stop loss, while the blue is where, let me confirm if it's blue. Oh, it's no market is not open today. That blue or green, but red basically is the stop loss. That is where you impute your stop loss figure. You can just come here and choose a figure that is below and put your stop loss. Then for take profit, you come a figure, if you are buying, a figure above and put your take profit. We're going to go further to this class. We'll still explain this stop loss and take profit. How do you calculate it in pips? How do you calculate it in pips? That will be when I'm going to, probably my next series, I'm going to explain how to calculate pips. So don't get bothered. Don't bother your head. You're going to know how to calculate the actual figures. But what I'm trying to tell you right now is how to set it, how to set your take profit and your stop loss on the phone. After you've placed your trade, you modify trade, and then you see the red parts, and then you see the either green or green or blue. You see it's just there. You see some figures there, or it might be blank. So on the red side, you put in your stop loss figure, which you can choose a figure below here, since you're buying a figure below here. Then put the figure above as your take profit. Since you're still doing demo, when market opens tonight or tomorrow, you can try it. Today is Sunday, so market is not open. You can try it and see. The same thing applies to if you're using a computer. After you've placed your order, once you place your order, you can see here it's showing me stop loss, take profit. But if I want to place an immediate order, it's an instant execution. Now in my next series, I'll also look at other orders that we have. We have it called pending orders. But for now, everything this buy and sell we're talking about is instant execution. But you can't set your stop loss and take profits on an instant execution. You have to either buy or sell first. So immediately you buy or sell. I'm talking about the computer. I've already explained about on using the mobile phone. Immediately you buy or you sell, then you have to go back. The trade will then be around here. Oh, great. I think I have a trade running. I have Euro USD running as a sell. Oh, I'm in profit. 8,960 naira. Great. So what do? You'd right click on the trade, and then you see modify. This is on the laptop. You see modify or delete order. So once you click on modify, it brings out this screen. Unfortunately, you see it's not highlighted because the market is closed today. So you see this here and you see this here. So you impute your stop loss and you impute your take profits. Pretty easy, pretty easy. So remember, you come below here to take out my face. You go away from here. So is this euro? Okay, now this is euro USD chart. What do I do? Since I'm selling, I'm actually selling. You can see I have a sell on euro USD, and I'm in profit right now. So what do I do? I would since I'm selling, I expect price to go down. So it means my stop loss has to be above. So I can pick this figure 1.08980 and put here as my stop loss. And I can zoom out, or I can just choose a figure below. I can choose this figure 1.0870 and put it as my take profit. I'll input it here. I can't do that now because market is closed today, being Sunday. So basically, that is it. It is that simple to place those orders, to buy, to sell, to set your take profit, set your stop loss. So that'll be the end of this particular series. So in the next discussion, we'll talk about candlesticks. So stay tuned Please hit the like button if you got value for this video. Make a comment if you have questions. And I've been seeing some very nice comments. Thank you very much. These are the reasons why I'm inspired to continue doing these videos. I see some people say some very nice things that, wow, that they've learned a lot better than they've seen in other videos I've seen in books. Thank you. You're an inspiration. Those comments are an inspiration. That's the reason why I wake up every morning and I say, wow, today I haven't done a video. I haven't sent out a video. So thank you. Keep it coming. I really appreciate it. And remember to subscribe to the channel. Hit the subscribe icon under the video so you would get notified when I release other videos. Thank you very much. I will see you in the next discussion. Have a good day. Stay safe. Bye.